ESG Investing. Is it DOA? Also on the program, we're going to be joined the second half by fellow certified financial fiduciary and National Social Security Advisor Rob Field here in the office in the Nelson Financial Planning Studios to talk about all things Social Security, specifically some of the changes for this year, and as we look ahead to some of the things that can impact your Social Security. Maybe one of those might be if you're having to pay more on your Medicare. No, that's not a reduction in your Social Security. It's that you have to pay more on your Medicare. So we'll be talking about all of that on the program. So welcome on in today to today's version of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries like Rob stand ready this week to help you improve your life with a successful and cost-effective financial plan. Before all that ESG conversation, we'll recap the week as we sort of like to do here in the opening part of the program. Nice bounce back, if you will, in the markets this week. Last week, we mentioned that there had been a 3% decline in what wound up being the worst week in the markets for the calendar year 2023. Hard to believe we're already in March, so the year is rolling by pretty quickly. I think mathematically we might be almost 20% past January the 1st of this year as of this date. And so nice to see the performance this week, a little bit of an improvement. Markets this week wound up just in general going up about 2%. So sort of a nice recovery off of what had been a less than a good week the prior week. And I guess that underscores some of the things that we always talk about on this program, and that is that volatility works both ways, right? You can have bad weeks, but then you can also have good weeks. And what studies show and what history tells us is that a lot of those bad times are actually clustered around those good times and vice versa, because, of course, volatility has two sides, up and down. Don't forget that when you're thinking about the headlines and what may be happening on a particular day. Remember, the negative news is always going to get magnified by the good folks in the advertising business. By that, I mean the media industry, because don't forget, they're in the advertising business, which means that the more eyes you get, the more you can charge for ads. How do you get more eyes? Well, you scare the crap out of people. That's how you do it. Anyway, so that's the first piece about volatility. And then the other comment that we've always made is that volatility loves company. There's a tendency in the markets when you start to see these more volatile periods of time, they don't just disappear instantaneously. They do have a tendency to kind of hang around, to stick, if you will. Speaking of things that we wish would disappear, or maybe is starting to disappear, some interesting headlines this past week about ESG investing, and we'll raise the question here in this first part of the program of whether it's DOA, dead on arrival. Although it has arrived, it may just be that it's dead considering a couple developments this past week, because certainly ESG investing is all that you've heard about over the course of the past few years. What, of course, is it? Well, ESG stands for screening for environmental, social, and governance orthodoxy. So if you're screening for ESG, you're putting in certain environmental or social or governance types of screenings, and you are then promoting that as the way that you are, in fact, managing money. That's the whole concept of ESG investing that's really taken off over the course of the past few years. We at Nelson Financial Planning, and I think if you're a regular listener to the program or you go back into the archives, whether that's on iTunes or on iHeartRadio or on Spotify or even on YouTube. At Nelson Financial Planning, we were always one of the few firms that did not really embrace it. And here's why. We want to talk a little bit about that on the program this week, and then also talk about these two developments that actually happened like in the same week within the past 7 days. The reality is that we feel very strongly that our duty, our fiduciary duty to our clients is about investment performance, not what some CEO thinks of the social issues of the day. We want those leaders of those companies that we're investing our client money in to be solely fixated on growth and profits. And I know maybe that might be a little dirty word about, we don't want corporate America making too many profits. But hey, guess what? This is a show called Dollars and Cents, and it talks about how you can improve your life and have a successful retirement. Guess what? One of the things that's necessary to have a successful retirement is to have some money. So how do you have money? Well, you own stuff that appreciates over time. How does stuff appreciate over time? Well, it's based on profit. So that's kind of the main thing. That's kind of the main focus. Now, we're not silly enough to sit here and say that external factors certainly come into play, right? You're not going to own a company that's dumping environmental chemicals into the local river, right? I mean, that's of course part of it, and that's always been part of it. But to screen the universe of companies with preconceived notions, that doesn't sound like keeping in the best interest of your clients. The motivation is always to make money. I'm sorry to paint it just that black and white, but hey, that's what it's all about. Despite that, the world seems to have swallowed this ESG concept, as they sometimes do, without second thought. Here are the numbers. Investment firms representing $59 trillion of client assets have signed on the Net Zero Asset Managers Initiative, an organization that is part of the $150 trillion as measured by the amount of assets under the umbrella of the organizations that sort of sign on to these alliances and initiatives. So the Net Zero Asset Manager Initiative is an organization that is part of the $150 trillion United Nations affiliated Glasgow Financial Alliance for Net Zero. Both alliances are committed to restricting their investments over time to companies that are compliant with Paris Agreement's objective of net zero greenhouse gas emissions by 2050. Enter the events of this past week. So that's the setup. That's the landscape. That's what's going on. Let's turn our attention to the events of this past week. But we're going to have to do that after the break. So stay tuned after the break. We're going to talk much more about the events of this past week and how they relate to this whole ESG investing. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program. We're talking about ESG investing and whether it's DOA on arrival. In the prior segment, we talked about what ESG investing is all about, right? Screening companies or the universe of companies for whether they meet certain environmental, social, or governance types of screens. The problem with that, and the problem that we've always had at Nelson Financial Planning with that approach, is that it eliminates or it weakens, in our view, the fiduciary duty that we have to our clients, which is that we want the most amount of money. We want the most amount of profit. That's what investing is all about. And that should be the sole focus as it relates to investing, because the reality is that anything else ultimately does nothing to improve your rate of return. We've said that for many years on this program, and now this past week, two different develops. We mentioned about the two global initiatives of all of the investment management companies that signed onto these alliances, these pledges to follow the Paris Accord and have net zero greenhouse gas emissions by the year 2050. Well, we mentioned that there was two different headlines that happened this past week that are directly on point. First and foremost, the folks at Vanguard became one of the firms that left this initiative, that withdrew from the Net Zero Asset Managers Initiative, that withdrew from the United Nations affiliated Glasgow Financial Allowance, that said, hey, you know what? We're out. Vanguard, one of the world's largest investment management companies. So we're going to read to you some of the things that the CEO of Vanguard, Tim Buckley, stated in an interview this past week with the Financial Times that explain why they did what they did. Some of this, if you've listened to the program before when we talk about ESG investing, should sound somewhat familiar. Number one, Vanguard's research indicates that ESG investing does not have any advantage over broad-based investing. In fact, over the past 5 years, of the active equity managers who outperformed the markets, not a single one relied exclusively on net zero methods. Loosely said, the results are in, they ain't good. If the fiduciary duty is to deliver client results and client investment performance, then no sense screening for that. Number two, ESG, if you stop and think about it, is actually a kind of a form of diversification. What do you mean by that? Well, diversification, right, is sort of the opposite of diversification. The point of diversification is you're selecting different companies to have a broad-based approach so that when things happen, there's other companies that might step up and have profit during periods of time where other types of companies are falling down. So if you are practicing ESG, you're in essence practicing diversification because you're clinging to a restricted list of companies and basically hoping for the best. So what'd you miss out on last year? The energy sector was up 60%. The tech sector was down 30%. If you'd had a diversified portfolio, owned both, yeah, you would have been okay. But if you were kind of following the ESG thing, guess what? You would have missed out on that piece that went up 60% to help offset the loss that was going off on the tech side of things. Exclusion, as with anything in life, any type of exclusionary policy in our view, but exclusion certainly never a good investment approach. What if a company that is doing good, if you will, and your definition of good and my definition of good may be different, and that's part of the other problem with the whole ESG thing. What if they're doing good but unable to deliver profits? Do you want to own that company? Probably not. Or what if the world has said, wow, these people are phenomenal and have sent the price of that company up so high that the opportunity to get additional profit going forward is probably not there. Do you want to own that kind of company? Number three, the political winds, as I think we all know, can blow in different directions based upon economic reality, based upon headlines, based upon changes in technology, right? I mean, see what's going on in Europe because of the Russia-Ukraine thing, and Europe's kind of had to change its tune on where it's going to get gas from and where it's going to get energy from. We have no interest, nor should you, in betting client money on whether politicians and regulators will consistently do the right thing. I'm not sure they will. It's highly amorphous when you start getting into this. And lastly, and most importantly, as we mentioned earlier in the program, the fiduciary duty to the client really is to achieve the best possible performance over time, to be good stewards of that money. So that's story number one. Vanguard saying, hey, you know what? This is just, it's too far. It's too much. Bottom line, there's not the performance there, so we're out. Vanguard withdrew from both of these initiatives earlier this week. That is story enough. But now let's forward to the second story that happened just this past week, and that's the first expected veto of the Biden administration. So this is it's just crazy that these stories have hit in the same week. Why is the Biden administration about ready to engage in its first veto of the Biden administration? Because the House voted 216 to 204 to block a Biden administration rule to allow ESG factors to come under consideration by retirement plan fiduciaries. There's a Labor Department rule, that effectively prioritize politics, if you will, over getting the best returns for your employer retirement options. The rule, by the way, not applicable to IRAs. Only to employer plans, because that's under the purview of the Department of Labor. Once again, another reason why, if you've got old 401ks, or if you're over 59 and a half and got a 401k, might want to consider rolling that over to an IRA, because the Department of Labor rules don't apply to IRAs. They only apply to qualified retirement plans, qualified employer plans. Because the rule effectively would have allowed retirement plan sponsors to use the ESG funds as the default option in the 401k. And let's face it, when it comes to default options, that's kind of what people take, right? They just kind of go with it. They don't bother to do it. So anyway, the whole default option, probably a topic for another show. So in a bit of a surprise, when this House resolution made it to the Senate, both Democratic Senators Joe Manchin and Jon Tester, Joe Manchin of West Virginia, Jon Tester of Montana, joined the Republicans to pass a resolution to repudiate this Department of Labor rule. So, if you're familiar with how kind of a bill works in Washington, right? Pass the House, pass the Senate, goes to the White House, where the current administration is on record. I don't think they've actually technically vetoed it as of the timing of this episode. They have said that they will, in fact, veto it, making it the first presidential veto of the Biden administration. Just too rich this week in terms of the headlines to not spend the first part of this program talking about this ESG stuff. Two major events, if you will, happening. The withdrawal of Vanguard from the Glasgow Financial Alliance, that happened on Monday, Tuesday, and then the whole conversation over the Department of Labor rule and the resolution that passed the House, passed the Senate, forcing the use of the first veto by the Biden administration. Certainly, this has shown a bright light on the shortcomings and failings, in our view, of ESG investing. Bottom line, as is always the case, and we've been doing this long enough to see these trends come and go, and we're going to do this, we're going to do that. Stay clear of any screening tools that don't put investor returns as the only thing that ultimately matters for your performance. We're going to take a break. When we come back, we're going to be joined by fellow certified financial fiduciary and National Social Security Advisor Rob Fields. Going to talk a little bit about Social Security, get me off this ESG thing and get me a little more calmed down, talking about a program that is running short. Well, I'm not sure that's going to calm me down, but we're going to try. Stay tuned after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program, ladies and gentlemen. This, of course, is Dollars and Cents. We're joined in the second half of the program by fellow certified financial fiduciary and National Social Security Advisor Rob Field. Good morning. Welcome to the program, Rob.
Morning, Joel. It's great to be here. Thanks for letting me come and be a guest today.
I know. Well, I think this is one of those rare occasions. We are here live in the studios on Sunday mornings, and so both of us got up and rolling and into the studio this morning.
And a beautiful Sunday it is, right?
Beautiful Sunday it is. You doing anything with Bike Week? I know you got a bike. Are you hitting Bike Week? Everybody else seems to be this week.
I may drive down there for a couple hours. It's pretty fun. I mean, a motorcycle does it's different than a car. Kind of opens things up for you. You want to be careful, but it's a big Daytona event with a lot of activity that I might just have to catch a piece of.
That is for sure. You said before the show that I guess one of our fellow associates, one of our relationship coordinators at the office, Zach, was there yesterday.
That is correct. He sent me some pictures and kind of got me motivated. Zach's the one who kind of helped me pick out my motorcycle and has been pushing me to. We took a motorcycle class together, so yeah, we're kind of brothers in motorcycles, so to speak.
Very nice. Well, it'll take some time. It'll take some of Zach's convincing of me and my wife for me to join that office club.
It is the second person you mentioned. I am divorced and did not have a motorcycle while I was married. I'm not going to go into detail, but now I do have a bike. So anyway, moving forward.
Good stuff. Well, anyway, I wanted to open the segment this way because I needed something to get off my mind of the ESG craziness that we were talking about in the prior segment. I know you were in your office listening to the show live on the iHeartRadio network. So
correct.
Good stuff on that. So
we've talked before about, our job is to help our clients' investments grow and to make decisions that may or may not be socially acceptable to then dilute or to give up returns. At some point, people are going to say, well, that's not my job, and that's not what they want.
Last year, I think, is a crystal clear example, which is why I think maybe it's getting sort of the relook by the mainstream investment community, because last year was a classic example of where that led to diversification. If you did not have energy in your portfolio, energy was one of the best performing, I think it was the best performing sector of the markets last year, up 60% versus tech down 30. It would seem to me that if you only own the down 30, then you probably didn't get as good a results as if you had that broader diversification that would have included energy companies.
And I think that reflects on us as investment advisors, where different people can talk about being socially responsible, and that's wonderful. But my job is to get performance, and that's what I'm going to be judged upon.
Bottom line fiduciary duty.
Correct, I agree.
Absolutely. Anyway, let's shift gears. Let's talk a little bit about Social Security. So give us some of the broad strokes on some of the bigger changes that have happened for this year, 2023. There's always some changes that happen with Social Security. Update us on some of the bigger ones.
Exactly. Be glad to. I thought I would share, I'm an advocate for Social Security and what it does and how important it is to coordinate it and to optimize it at its best. I always like to share a few statistics just to kind of remind people where Social Security does fit into a retiree's overall plan. For about half of retirees that are over age 65, Social Security provides more than 50% of their total income. And there's actually 1 out of every 4 adults in that same category, age 65, retired. Social Security makes up 90% of their income. And so one thing I like to point out is, thanks to Social Security, there are only 9% of Americans who actually live on an income that would be considered below the poverty level of $14,580. If we didn't have Social Security, that number would be about 40% of retired Americans would be living on an income that would be under the poverty level.
Wow, that's really unbelievable when you stop and think about how dramatic those numbers are.
Right. It's a lot of people think, well, it's just a small something, but for many people, Social Security has become a big part of their income. Social Security was sort of came out years ago with the thought process of to supplement pension plans and other investments that people might have had. Typically, years back, people would buy a house, they would live in that same house, pay it off, retire, and then reduce their house payment, have their pension from their work or 401k, and then the Social Security. And in today's age, a lot of people are buying and selling houses, the equity's not there, or they never really took advantage of an IRA, or pension plans have kind of dropped off, and then Social Security, unfortunately, probably has not kept up with the cost of living. So A lot of people are struggling with it. Also carries over to the spousal benefit, because some people that may not have worked or had a very low income range can take advantage of a spousal benefit. So that's another way to add a little bit of extra income to the household. Now, we were talking about some of the changes. Every year, Social Security adjusts some numbers. The one number that people like to keep an eye on is the how their income is taxed. That's the way that Social Security brings in new dollars, is to tax our earnings. Right now, they will tax you up to $160,200. That's gone up over the last few years. Years ago, it was 130, 140, 150. Now we're up to 160.
They've been raising that one at a pretty good clip in terms of the increase of the amount of wages that you have to pay the Social Security tax on.
Correct. You're actually paying 6.2% of your income into Social Security, and that funds Social Security. And of course, people that are collecting Social Security are taking advantage of that, and it's a big piece. And so we hear a lot about Social Security and will it be there in the future. And so they are making changes constantly every year to try to bring in more funds to fund the current Social Security and anticipated Social Security amounts in the future. We've seen the typical change over the last few years of full retirement age. That's that magic number that Social Security kind of base either your decrease if you take it earlier than full retirement age, or the increase if you were to take it up to age 70. Full retirement age is also the point where you can work, collect any kind of income that you would like, and not have a reduction in your Social Security. We're seeing more and more of that. Years ago when Social Security came out in the 30s, people hitting 65, that was sort of getting out of the workplace and moving forward. Now we've got people working much later. Social Security will increase that full retirement age because what they don't want to do is have people working, making nice incomes, and at the same time paying them a large amount of Social Security. So sure. To preserve it, they want to push it back. Full retirement age will continue to go up. We've seen a lot of things in Congress and coming from in the politicians that are talking about changes. There was one guy who said he thought full retirement age should be age 70, that's a pretty severe movement. But if you think we've gone from 65 to 66 to now, if you were born in 1960, your full retirement age would be age 67. Those are changes that have occurred. Hasn't moved up for this year, but that's always on the drawing board.
Well, and given life expectancy, that is something that I think we do need to talk about, because folks are living longer. When the program first started, for the most part, people weren't living past 65, but now they certainly are. And so having that adjustment in terms of that full retirement age certainly makes sense. I think when they look at that, and obviously this Social Security also has some important political factors, when they talk about raising that age, I think back to when they raised it from 65 to 67, that didn't really impact anybody that was within 15 or 20 years of the Social Security ages that they had sort of grown up with. Those changes typically impacted people in their sort of 20s and 30s. And so it wouldn't surprise me if that's sort of where they look for one of the many ways to kind of address the shortfall.
Very much so.
That is for sure. So anyway, we're going to take a break. When we come back, we're going to continue the conversation about Social Security and some of the changes that are afoot. Coming up next here on Dollars and Cents with Joel Garris, Rob Field of Nelson Financial Planning. Welcome back to the program. This is, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of great folks who also happen to be certified financial fiduciaries and, in Rob Field's case, National Social Security Advisor, stand ready this week to help you change your life with a successful and cost-effective financial plan. So we're talking a little bit about Social Security on the program today. Let's fast forward to the thing that everybody alleges or thinks that, hey, wait a minute, my Social Security got cut. Why did my Social Security get cut?
Right. We're talking about the Medicare Part B. So, Medicare A was covered and you don't pay for that. You get your Social Security. Part B, which covers your doctor part, is then debited back out. There was a large increase for many of our listeners on what they're paying for the premium for Part B. The higher your income, then it's the higher premium that you're going to pay on the Part B. That's going to cover the Part B as well as the prescription drug coverage. That additional premium that goes up beyond what you normally pay, they call that the income-related monthly adjustment amount, or IRMMA. Medicare and Social Security, they're going back about a couple of years. So right now they're reviewing, or they did review, your 2021 tax return. And if that year income was a little higher, and for many people, either due to COVID or some of the growth in the markets and the taxation of that, they ended up having a higher income level for that 1 year, and so their premium went up. And a lot of people were panicked. They thought this was incorrect because they hadn't seen that before. It's to get that number, they kind of come up with your modified adjusted gross income for purposes of the Part B premium, that MAGI. It's going to be your adjusted gross income that's reported on line 11 on that federal tax return. Add back in any tax-exempt interest, such as your muni bonds, that's on line 2A. That amount determines what you're going to pay, or if you're going to pay more for that Part B premium. And so it adjusts every year. So one way you could look at it is, if it's an anomaly, 1 year was a little bit higher than normal, so be it, it'll reduce back down. You can dispute it. We've had a couple of people that have utilized a form. It's SS44, in which you can dispute, or you can try to request a reduction. I've got one of those forms in front of me. It's a lot of times if there's a life-changing event.
Right, and it has to be something that sort of checks the box, if you will, for a life-changing event. What is not interesting, a life-changing event, is if it is a one-time transaction. So where we often see this, to your point, Rob, is where we've got people that, just maybe they sold an investment property, or maybe they inherited money, or maybe their spouse passed. I mean, whatever the case may be, it wound up sort of fundamentally changing their income for that single year. And ultimately, those one-time transactions, although in the examples that I just gave, the death of a spouse is actually one that you could use to sort of argue your way out of the increase. But if it's sale of an investment property or inheritance or something like that, then you're stuck with it, for lack of a better explanation.
True. I mean, when you say check the box, that's literally what you do on this form. Is you say, I'm disputing it, I'm going to argue. You check either it's a marriage, a divorce, death of a spouse, work stoppage, work reduction, loss of income from producing property, as you mentioned, loss of a pension income, something from your employer. And you literally take this form and check the box of the event you think it is, talk about what you think your income should have been, what your modified gross income would be, and then the documentation that you want to provide showing that. And then you give it a shot. You just simply say, I'm disputing it, I want it changed. Again, it will readjust every year. So if you wait too long, it's probably just got to live with it for this year and then move on to the next.
Right.
But it did catch a lot of people off guard, because medical insurance is expensive to begin with. Anytime you see an increase in your premium, it's a little nerve-wracking. It's
almost like a repeat of the conversation that I think we started having probably 15 years ago with our clients, when it comes to the actual taxation of Social Security, which back in those days, when you first started seeing your Social Security get included as part of your income on your tax return, that sort of surprised people. Now, I guess everybody is used to that. So how does that work in terms of the inclusion of your Social Security as part of your taxable income?
Great question. And of course, this time of year, that pops up a lot. People asking us, well, is my Social Security taxable? How much of it? And it's all based on your combined income. And so you calculate that by taking the adjusted gross income, throw back in the tax-exempt income. Then for the calculation of if it might be taxable, you throw in 50% of your Social Security benefit. That creates this thing we call the combined income. Social Security looks at, and the IRS looks at that number, the combined income, and then they just run it through a variety of thresholds.
And what's always interesting about that formula is that they make you throw 50% of your Social Security back in to determine, whether you have a high enough income that's going to trigger taxation of your Social Security.
Right. It is kind of a roundabout way to decide, should we tax your Social Security? Well, first, let's throw 50% of it into the calculation. Then we'll tell you whether any or part or all of it are going to be taxed. And so the thresholds for a single return, if you're under $24,000, then probably none of your Social Security would be taxable. If you fall into a $25,000 to $34,000 range, up to 50%, and again, could be taxable. Again, it's not black and white. This is something that drives accountants up the wall, because, like you say, you throw in the number, you come up with combined income, and then maybe not, depending on the threshold and some other things, will it actually be taxable. But the the bottom line answer is Social Security can be taxed, and you want to be aware of that.
Right. No, absolutely. And what's frustrating about the taxation of Social Security, and it goes back to kind of where we first started seeing this more and more, probably 15 plus years ago, is that the threshold numbers, those numbers, never index for inflation.
Correct.
So these the thresholds that trip Social Security to become taxable are numbers that have never changed. And so more and more people, and I would dare say pretty much effectively the vast majority these days, find that their Social Security gets included in income when it comes to their tax return. So certainly a frustrating experience and a surprise to a lot of folks.
Right. Like you say, income goes up, but the thresholds aren't being adjusted for inflation. So you can blow past $25,000 in income fairly quickly, and then boom, some of your Social Security is going to be taxable.
So in sort of the final minute or so of the program, any update on sort of the Social Security trust fund numbers? What's the future, if you will, of Social Security as we know it?
Sure. So Social Security's got two things that fund it, is the new money coming in from the taxation, and then it does have a trust fund that's got almost $3 trillion worth of assets. Now, that $3 trillion dropped down to 2.9. That's $100 billion, and by itself, $100 billion we've talked about before. That's a big number, except from 3 to 2.9 to 2.8 is not that drastic. So at the same time we see that going on, people panic. Oh, if you run the numbers, nothing changes. Social Security runs out in 2035 or whatever it would be.
Right. Or not necessarily runs out, but can't afford to pay the same benefit, which means that everybody across the board would have some kind of reduction if they don't do anything.
Correct. They think it would run out, but you're right. In truth, it's just simply new money would keep coming in. But one thing we're looking at would be with interest rates going up, and the trust funds are made up of government bonds. Hopefully that'll beef it up a little bit.
In terms of the performance number.
Mm-hmm. Mm-hmm. Payroll tax keeps going up. They keep bumping up full retirement age.
Certainly some things to think about as it relates to Social Security. Well, that's about all for this week's episode of Dollars and Cents with Joel Garrison, Rob Field of Nelson Financial Planning. If you like what you heard and want to learn more about how our team of certified financial fiduciaries at Nelson Financial Planning can help you improve your life, give us a call this week, 407-629-6477, or visit us on the internet at nelsonfinancialplanning.com.